Okay, for any professional who manages retirement accounts, you know that a missed required minimum distribution, or RMD, is a huge headache. But what if you could get that penalty completely waived? Well, it's absolutely possible, but only if you know the IRS playbook. So today, we're going to do a real technical deep dive into how you prove reasonable cause and correctly navigate the super important IRS Form 5329. All right, here's the game plan. We'll kick things off with the penalty framework. Then we'll break down the legal test for getting a waiver. From there, it's all about the practical steps, fixing the error, walking through the form line by line, really understanding what the IRS considers reasonable, and then finally, how to draft a waiver statement that's actually persuasive. So first things first, let's talk about the stakes. When an RMD is missed, the IRS hits you with what's called an excise tax. Now, this isn't your regular income tax. Think of it as a separate penalty for not playing by the rules of tax deferral. Thanks to the Secure 2.0 Act, which kicked in back in 2023, the base penalty for an RMD shortfall is now 25%. This is a pretty big change, and really getting a handle on this new structure is step one in dealing with it.
And wow, the difference here is night and day. Before Secure 2.0, the penalty was a jaw-dropping 50% of whatever amount was missed. The new system is way more nuanced. It starts at 25%, but, and this is key, it gives you a way to knock it down to just 10% if you act fast enough. It really seems like the law is finally acknowledging that a lot of these RMD failures are just honest mistakes, not someone trying to dodge taxes.
So how do you lock in that lower 10% rate? You have to fix the mistake within what's called the correction window. This is all laid out in Internal Revenue Code Section 4974E. For example, let's say someone misses a 2024 RMD. That window is usually open until the end of 2026, unless the IRS gets to you first by sending a notice or assessing the tax. The bottom line here is simple. You have to act fast.
But what if you could get rid of the penalty entirely? I mean, paying 10% is way better than 25%, but you know what's even better? Zero. And thankfully, there's a legal path to a full waiver, and it's laid out right there in the tax code.
This is the exact language pulled straight from IRC Section 4974D. Now, pay close attention here. It's a two-part test, and you absolutely have to satisfy both parts. And get this, the burden of proof is entirely on the taxpayer to convince the IRS that they meet these conditions.
Let's break this down. First, you have to prove the failure was a reasonable error. And don't worry, we're going to define that in just a bit. Second, you have to show that you're taking reasonable steps to fix the problem. These aren't just suggestions, folks. They are the two pillars that your entire waiver request is built on.
Let's actually tackle that second part first, the reasonable steps, because honestly, it's the most clear-cut and absolutely non-negotiable part of this whole process. I'm talking before you even dream of writing that explanation letter to the IRS. The missed RMD has to be taken out of the account. This is the single most important reasonable step you can take because it shows good faith. You want to be able to tell the IRS without a doubt that the financial error is already fixed. Okay, you've taken care of the money part. Now for the fun, the paperwork. This means we are going to do a very granular, line-by-line walkthrough of Form 5329, and specifically, we're looking at Part IX, which is titled Additional Tax on Excess Accumulation. Just as a quick refresher, here's the basic RMD calculation. Usually, errors happen in one of two places. Either the numerator, the account balance is wrong, or the denominator, that life expectancy factor from the IRS tables is wrong. Using the wrong table or an incorrect account value, well, those are classic examples of what might lead to a reasonable error. Now, on the form itself, the first couple of steps are just simple data entry. Line 52 is for the amount that should have come out. Line 53 is for what actually came out, which, might be zero. These two lines just establish the basic facts of what happened. All right, now listen up, because this is the most critical step on the entire form. You do not just subtract line 53 from 52. No. Instead, on line 54, you enter a big fat zero. Then, right next to it on the left, you write RC, which stands for reasonable cause. And then you put the actual shortfall amount in parentheses. This is the official smoke signal to the IRS that you are requesting a waiver. And here's the magic of that little move. Because you put 0 on line 54, guess what line 55, the line that calculates the tax, is going to be? Yep, also 0. You're not hiding the failure. You are formally reporting it while at the same time asking for full relief.
From here on out, the fate of your request lies completely in that explanation you're going to attach.
So, what's the secret sauce for a winning explanation? Well, to figure that out, we can peek behind the curtain and look at how the IRS itself defines reasonable cause. And for that, we can go straight to the source, their own internal playbook, the Internal Revenue Manual. According to the Internal Revenue Manual, or IRM, the magic phrase is ordinary business care and prudence. So, what does that actually mean? The key question an IRS agent is asking is this: did the taxpayer act responsibly, but was still unable to comply because of some specific circumstances? That is the exact lens they're going to use to review your case. And the good news is, the manual gives us some pretty clear examples of what they'll likely accept. Things like a serious illness, a documented error by the bank or brokerage, records getting destroyed in a fire or flood, or even just confusion over complex tax laws, like all the recent changes to RMD starting ages. These are all things the IRS generally considers valid reasons. But on the flip side, the IRM is also crystal clear on what's not going to fly. Simple forgetfulness? Nope. Just saying a mistake was made without any backup? Not going to work. Blaming your accountant or just saying you didn't know the law? These arguments almost always fail because they aren't considered examples of exercising that ordinary business care.
All right, we're on the home stretch. You know the standard, you fixed the financial error, and you filled out the form correctly. The final step is to draft the waiver statement itself. This is where you build your persuasive case.
A really solid statement needs to have a few essential parts. First, cite the law. Then, give a really clear timeline of what happened and why it was a reasonable error. You have to confirm the date and amount of the correction. And this part is huge, you have to attach your supporting documentation. A letter from a doctor or a statement from the bank gives you objective proof that can absolutely make or break your claim. And you can think of it in a simple 4-part structure like this. Your opening just cites the law and says what you want. The narrative is where you tell the story of the reasonable error, the proof of correction shows you've taken those reasonable steps, and the last section points the IRS agent directly to all your evidence. It's clean, it's organized, and it's effective.
Look, if you remember just one thing from all of this, let it be this: getting a waiver is a 2-part mission. It's that simple. First, you fix the money problem by taking out the distribution. Second, you fix the paperwork problem by proving the original error was reasonable. You nail both of those, and you're in a great position. Everything we've talked about today is reactive, right? It's about fixing a problem after it's already happened. But now you have the IRS's internal playbook. You know what they consider a valid excuse. So the real question is, how can you use this information proactively to maybe update your client processes and prevent these failures from ever happening in the first place?